particularly noisy and chaotic democracy, and we see these wild swing in expectations, positive to negative to positive. And in that noise, a lot of the relevance of these building blocks gets lost. Growth improvement, of course, in the very near term will continue to be uneven and gradual. I think the negative fallout on the real economy of the demonetization and its implementation will only worsen that profile in the very near term, no matter how positive it might be over the longer term. More relevant is purely in terms of reform and policy implementation, the building blocks which really matter from a medium-term sustained growth upturn are actually falling into place. Our sense remains that this process in the second half of the Modi government's tenure will actually continue. I would expect actual pace of reforms and even the bandwidth as far as reforms are concerned will perhaps be slower in the second half. The focus is going to be much more on implementation. Don't forget, we've got GST implementation coming through, bankruptcy legislation implementation coming through. For the next 6 months, the whole demonetization fallout will have to be managed. All of these are going to keep people busy. But beyond that, I do think the economic cycle will begin to improve and actually will set a pretty powerful positive stage going into the next general election cycle in 2019. I think good economics beyond a certain point also has good political dividend. And I think gearing up for the next election cycle, this will clearly be an important parameter. Obviously, the big focus is on the surprise, very bold demonetization move. I think what is getting overlooked is perhaps the poor implementation, fully well acknowledging the surprise element that had to be in this particular thing. And this is the implementation aspect which will really create a bit of a hiccup. Think of demonetization if you just want to replace your currency as a bit of a blood transfusion. But what India is going through is cardiac arrest, followed by a blood transfusion, simply because the liquidity squeeze that comes about, not just because of the destruction of quote-unquote black wealth, but equally in terms of ongoing activity. So truckers are not able to move simply because toll operators, there's no small change to give it back to them. So there are many of these aspects which perhaps would have been thought earlier from an operational perspective so that the hiccups could have been managed a lot better. So we will see for the next certainly 1 quarter, if not 2 quarters, real economic activity getting impacted, but that will slowly pave the way for a better cycle down the line. I think people are underestimating, and this has been our view even before this demonetization move, as to how aggressive RBI is going to be. We continue to highlight at least 3 repo rate cuts over the next 12 months, including one at the December meeting. I think some of the negative impact on the real economy from demonetization and its implementation strengthens the case. Also, don't forget, part of demonetization and the hit to the real economy is actually going to be disinflationary, and that once again presents an opportunity for the central bank to actually ease. One interesting aspect worth bearing in mind is what's happening globally. Go back to 2013 taper tantrums, and the rupee and India just fell out of bed as the bond yields in the US started rising. What you're seeing now is something very different, and that just underlines how many of the prior fault lines have already been corrected. So India is in a far better position today to be able to deal with US monetary tightening. So we do expect a rate increase in December as far as the Fed is concerned, and 2 more rate increases in 2017. Despite that, I think there's enough scope in terms of how the cycle is shaping up for RBI to actually come through with rate cuts. Interestingly enough, both the rupee and Indian bonds have actually outperformed on a relative basis, and that just highlights how compared to 2013, the underlying situation has actually improved. Part of the outperformance for Indian bonds is also related to this big flush of funds into the banking sector, which, given India's financial repression, the still weak demand, banks will just go ahead and buy more of government bonds pushing yields lower. A lot of it has already been priced in. I would imagine part of this liquidity will also find its way into mutual funds because banks really won't have much to do with it overall. So I just want to highlight, I mean, people are generally worried about what's happening in the U.S. bond market and global bond correction that's ongoing. In an interdependent world, there is no such thing as no country is an island. So yes, asset prices will be impacted. What is relevant is that on a relative basis, India will actually stand out in a much better manner. And finally, one important aspect which I'm actually surprised that more people are not talking about, I think a lot of what we are seeing now, despite the very near-term pain that has to be digested, a lot of it because of shoddy implementation, the stage is getting set that India's sovereign credit rating actually gets upgraded in about 12 months' time. Rating agencies typically move slowly, both on the way up and on the way down. They certainly would want to see some implementation aspects and how it is managed. So whether or not GST starts off on April 1st is not really the issue, even if it is a few months late. It has to be kicked off by September, and thereafter 3, 4, 5 months of some implementation. So I do think the way things are moving, the scope for India getting upgraded in its sovereign rating is actually real, and the probability is increasing. Let me stop there and open up for questions.
Margaret from NDTV. Uneven. You know, that's a word that came through in your thoughts. Do you think that the timing of demonetization could have ideally been different, given that a big building block like GST is being addressed at this moment?
It certainly could have been, because, I mean, ultimately, I don't think this was mainly an economic decision. The timing was not just an economic decision. We've known about a black economy, cash black economy, although my sense is I think everyone is overestimating how much of that cash is really black. So all black money is not in cash, and all cash is not black economy. Japan, Switzerland have very high proportion of cash as a percent of their GDPs. It doesn't mean that all of it is black economy. But your point is well made, that introduction of GST itself, no matter how imperfect or the design which we thought could have been bolder, it would still improve tax compliance. So some of that would have started to happen in any case. Equally, it also seems that the decision has been done in a bit of a hurry. Whether it has been brought forward or not, it's anybody's guess. But that last mile connectivity from an operational perspective, when you think through what the fallout is going to be, to make sure a lot of those hiccups are sorted out, that seems to be missing. Element of surprise or the necessity of surprise doesn't mean implementation has to suffer. In fact, armed forces give us good examples all the time. Corporate strategies give us that example all the time. So clearly from an operational perspective, real life transmission perhaps was not an important or a useful input, which is why we're seeing some of these ex post adjustments that are coming through on a daily basis, that here is a problem, let's try and deal with this, here is a problem, we're trying to deal with this.
With both GST and demonetization, you expect tax to GDP ratio to improve. And secondly, you said the timing of the demonetization is not primarily an economic decision that you're expecting.
Well, I don't...
Do you think that there will be a fallout on the upcoming elections of the mess that has been caused because of the demonetization?
Well, the whole idea about moving ahead with demonetization, so there was the economic argument in trying to address the black economy, or at least a cash component of that. There is the issue about fake notes. There's the issue about terror financing. So there are many other parameters that also go into. There could clearly be a political angle. I mean, that can only be speculative at best. What we're talking about is, why now? I mean, it clearly had to be after Diwali. You're 2 weeks after Diwali. A lot of the traders, businesses would still be sitting on fair amount of cash, given that the Diwali season itself is a big part of the full year sales. That is part of the reason also why this very strong support base for the government would also be pretty upset. So it's interesting how the divide in terms of who's upset, who's not, is very clear. If you're not impacted by it, you think of it as a great move. If you are, you have a different perspective. And then there's a large component of people who are in between, who are suffering from the inconvenience aspect, right? I mean, that's relevant, but that's not the most important aspect per se. Will tax to GDP improve? Yes. But not because of this very strange calculation that seems to be floating around, that somehow lower currency liability on RBI's balance sheet will offer the central bank to be able to give a big lollipop in dividend to the government, and all of a sudden India's fiscal issue will be solved, we'll have enough money for bank recap and for additional spending. I think you just need to take a step back and think through the intuitiveness of that explanation, and it falls flat. If all countries wanted to fix their fiscal, and all emerging markets have, varying magnitude of a black economy, nobody would do anything. I mean, IMF should actually be putting forth this particular response that, look, just demonetize. There'll be a big windfall given to the government, and the government would be laughing away everywhere. So it's too simplistic. It doesn't happen like that. And I think part of the confusion is central bank's balance sheet, because it impacts monetary side of the economy, doesn't operate the same way as a private sector's balance sheet. There are essential differences. So I don't think there's any big lollipop waiting to be transferred to the government in terms of higher dividend. Equally, don't forget, government at any point can always dip into central bank reserves. That's a completely different decision from, you don't need demonetization for that as such.
But having said that, banks will have now more deposits.
So,
your bank cap requirement will lower.
Well, you have to understand, bank deposits initially will surge big time simply because all notes that are to be exchanged have to be first deposited. Also, there is a cap on how many new notes are being issued, which will progressively be lifted. So net, by the end of this exercise, the cash in the economy, right, rather than being 12% of GDP, might be, let's say, 2 percentage points lower. But the deposit mobilization will also come off from its peak, but end result will still be higher than before, which is why I said more deposits also means, because of financial repression, they have to buy bonds or they have to lend it out. That's a different story. Cost of funds will come down. A lot of the numbers or the durability of that impact perhaps are getting exaggerated. We just have to wait and see how much creativity has been at play and how much actually comes back. Net, certainly a positive impact. A lot of the sensitivities and elasticities we'll have to figure out. It'll be a good test case. So, difficult to quantify altogether. I mean, one very rough, crude way of thinking about it is roughly 1 month of activity actually suffers. So that means on a 12-month basis, on an annual basis, you roughly shave off about almost 3/4 of a percentage point of GDP. Obviously, the impact will be captured much more in the near term. But don't also forget that at least for 2, 3, 4 days, you would have seen this exceptionally big surge in spending, which will act as a bit of a counterbalance. I don't want to play it up because the net impact of the overall move would still be negative from a downward shift altogether. The impact will be more pronounced as far as the informal economy is concerned, which is predominantly cash economy. And that is where I come back purely on the implementation side. Is there a reason why truckers had to suffer because of this? Probably not. Is there a reason why 2,000 rupee notes are being pumped in more rather than 500 rupee notes, which is a smaller denomination and therefore would have worked out well? The whole recalibration as far as ATMs are concerned. So a lot of these are operational issues which could have been addressed without compromising the surprise element. It just required some operational input.
And what does this mean for gold? That will be again the fancy.
See, you have to appreciate one thing. What we've gone through in terms of a demonetization is a one-time purge. It does not address the creation of black money. That is all to do with the incentive or the disincentive of those transactions. So in the informal market, gold prices might have surged overall, but net, depending on how well the government follows up with other measures, so therefore the actual creation of black money itself is at risk. That is the most sustainable solution.